Good afternoon, everyone. Thank you so much for joining us today. My name is Maria Asher, and I'm a co-portfolio manager on Westwood Select Equity and Dividend Select Strategies. Today, we wanted to take this opportunity to talk about what's been going on in the markets, our outlook, and the opportunities we are seeing. For that, we have Leah Bennett and Adrian Helford joining us on the call as well. Leah is the president of Westwood Wealth Management, and Adrian is our CIO and the director of multi-asset portfolios. Hi, Leah and Adrian. How are you doing?
Doing great. Thank you, Maria.
Great.
Thank you. So let's get started. It's been an interesting year to say the least. Markets are up about 19% as of today. Markets being S&P 500 index. At the same time, the so-called Magnificent Seven stocks have contributed to most of the returns. Can you please recap the market action this year and what has been happening in the markets? Adrian, you can go first.
Sure, thanks. You did a brief good one right there of following a stinker of a year in 2022. 2023 so far has delivered much better returns, not just in equities, but also in fixed income. Even though fixed income is down, not so much what we saw in 2022. 2023 so far, yes, the S&P is up 19% as we stand for year to date. Let's put that in context. For that 13 years prior to 2022, the average return was 16%, and that was high. That was a low interest rate environment. So it's been a pretty strong year. But, and this is a very big one, it's very concentrated in 7 stocks that are the mega cap stocks, not just the mega cap stocks, but primarily technology as well. Think Apple, Microsoft, Google, Amazon, Tesla, Nvidia, Facebook, now Meta. They contribute over 100% of that return. I almost have to recap that. So the market's return, the S&P is up 18%, and 7 stocks contributed over 100%. The not so great 493 stocks in the S&P 500 are actually on average down just a smidge on the year. That's opportunity. That's opportunity for valuations that potentially are left behind. Let's just talk about real quick the why and what that means. The why is, well, one reason is quality has performed. These stocks are generally low debt in orientation. Markets have been rising and interest rates have been rising, and so they're less concerning. It's almost like tech is a safe haven in this instance. And of course, the big elephant in the room is artificial intelligence, for which these are beneficiaries, and we're still trying to figure out and evaluate where the revenue generation is going to come from. The easiest and first place to look at is companies like Microsoft and Apple that are at the forefront with large technology operations sitting in the back room doing research and having opportunity for that. That will broaden out. That leads to the what does all this mean? Those 493 stocks left behind, that won't persist. The valuations are reasonable, and in some cases, they're downright cheap. Small cap stocks are only up around 3.5% on this year. Hard to believe when you just look at the S&P 500 on CNBC and it's up 19%, and you go, small cap is only up 3.5%. As I said, that won't persist. Valuations there are, in many cases, not just fair, but they're cheap, and investors should find ways to take advantage of that. I'll just finish and say that, of course, it's not just the equity market. The fixed income market is better than it was last year, but rates are still rising. And we've seen the 10-year U.S. Treasury now that's up around 0.7% for the year, up to around 4.5%. We briefly touched the live wire of 5% on a 10-year U.S. Treasury before coming back down, just based on growth. And over the course of the year, kind of as you asked, we've seen those scary jitters coming into Halloween, no pun intended, or pun intended. And those were some scary jitters around lower expectations of growth and maybe a higher for longer Fed. But since Halloween, it's been less scary of a market. The S&P 500 is up around 10% since October 27th. And that's primarily, we believe, on an increasing signal from the U.S. Federal Reserve that they may not be hiking rates. Well, they may pause, or they may simply not be hiking rates any longer at all, as CPI looks like it's falling.
Yeah, and I think I've heard every adjective for the Magnificent Seven, the Surging Seven. I mean, you can put all sorts of different descriptive words in there for what those 7 stocks have done. And you now have 7 stocks that comprise 30% of the S&P 500. So this is one of the most concentrated markets we've had in decades. And as Adrian mentioned, it definitely creates some opportunity. There are definitely reasons why those 7 stocks have done well. Even if you look at projected earnings for those companies for the fourth quarter, they're projected to be up about 15%, which is pretty attractive. They do have great balance sheets, as Adrian mentioned, and in an environment where interest rates have been high, quality has been important and really strong balance sheets. Companies that don't need financing have certainly outperformed. But I do think when you find environments like this where the divergence is as large as what this has been, usually you see an environment where either the market's about to roll over or the broader market is going to catch up. And I think there's lots of reasons to kind of come to the realization that the broader market is going to catch up or has the potential to catch up. And we've already started to see that to materialize. So I think there's some reasons to be optimistic, but you really have to dig into the composition of the market to really understand what's happening.
Thank you. This is helpful. And I think let's talk about the sudden surge in yields that we saw starting in August. Obviously, they have come down a bit, but how concerned are you about the impact of higher for longer term rates? Adrian?
Good question. It hasn't been just August. It's been obviously going back to when they started hiking rates, but at the start of the year, as I said, we've seen the 10-year U.S. Treasury rise significantly, and we saw some of that at the beginning of the year going into when, if you recall, Silicon Valley Bank and the regional banks experienced some difficulties. Make no mistake, that was in part due to the rising rate economic impact that was being impacted there for the banks, where their liability book was going down in value. So it does have real world implications. If you look at our capital markets outlook, we recently published a little bit on this, just showing some of the interest rate panorama, showing credit card loans for consumers are going up from 16 to, in some cases, upwards of 25+%. So if you're charging on your credit card for continued spending, it's higher. Home mortgage rates, gosh, I don't have to tell you, because I'm sure everyone on this call has seen what's happened. 2 years ago, you could get a 3.5%, maybe even a 3% mortgage. Now that's upwards of 8%. That's much higher. Corporations that have to fund for their growth for projects. Maybe they've got a project that they think is going to be a return on equity of 8%, where they go buy a machine to make more widgets and sell it to consumers. Suddenly they have to borrow at 9%. It reduces their return on equity. It reduces the possibility of that project. Now maybe they don't do that project anymore. So there's a real world implication of rising, and not just rising, but as you said, the quickly rising long-term yields. I'm a little surprised personally that we haven't seen more manifestations of some of the risk come through, but I will say that high nominal economic growth, we've seen the US economy that has grown over 22% in the last 3 years on a nominal basis. It's grown by over a fifth in the last 3 years. It's pretty surprising. That, of course, washes away a lot of the tears of higher rates. So as long as we have good growth, then we can have surging yields, or I should say higher yields. If we start to see a lackluster growth dynamic without a response in yields, that would be more concerning.
And it's always kind of interesting when you see an environment like this. I mean, I completely agree. It's surprising how strong the economy has been, given where interest rates are. But it also is creating some dislocations, which is great from an investment perspective. So Adrian mentioned what's going on, what happened with Silicon Valley and with First Republic. As you've had funding issues with the regional banks, there is a need for like private credit in some areas because some regional banks aren't able to fill the need for credit at the local level. So there's definitely some areas that we're seeing as being opportunistic places to allocate capital in an environment where we might have interest rates a bit higher for longer.
Thank you. That makes a lot of sense. So let's shift our focus to something that is very important to our clients, and it is inflation and the Fed action. So we got the CPI data yesterday for the month of October. It came in weaker than expected. How encouraged are you by the overall report, and do you think the Fed Reserve is done hiking the rates? Adrian?
Sure. Just to put in context as well, The lower CPI that came in yesterday, sorry, it's not lower CPI, it's the lower than expected CPI, came in just 0.1% lower. And the exuberance that we saw in the market yesterday are a real good signal for how important the Federal Reserve is and how important this data is for the Federal Reserve in potentially stopping their rate hiking cycle that we're going through. It is very important. We are still at an elevated inflation rate. Recall that the Federal Reserve, the US Federal Reserve, has a target inflation of 2%, and core inflation came in yesterday at, I believe it was 4.1%. So it's coming down, and there are a lot of signals that wage inflation is coming down, and other areas of the economy that are impacting consumers are seeing lower inflation, higher prices, just not rising as fast as they were before. So it's concerning, and of course, in the monthly inflation data that we see coming out, we'll continue to watch for individual areas, shelter, healthcare costs, and other areas of inflation to see if that's impacting the consumer. But what we saw yesterday, as I said, just 0.1% off of a 4.1% inflation rate, and we saw the markets up almost 2%. We saw rates come down dramatically. It was a big signal as far as a sigh of relief, somewhat, I think, from the market psychology overall, that the Fed might actually take this as a good signal that they can wait and watch a little bit longer, if not completely stop hiking rates.
Yeah, and we started this call talking about the Magnificent Seven and how concentrated the market has been. So as interest rates start ticking down, what does that mean across the board? And Adrian mentioned that the market was up 2% yesterday, which is great. But again, if you dig into the composition of the market return, companies that have really strong balance sheets participated, they were up. But really, the companies that really need financing or have the opportunity to refinance at a lower interest rate level are really the ones that performed exceptionally well. So you really have the broader market did much better than the 2% return you see across the market. And again, that's kind of where the opportunity is.
Thank you. So I think it's safe to say that Fed is probably done rising rates, or maybe we are very close to peak rates. Given that, what kind of portfolio changes that you all are making in client accounts?
I think the Fed is probably close to being done. Whether or not there's one more hike out there, it's hard to know. This is one data point. But I do think it's the time to start looking at changes. And again, Adrian mentioned that small caps really have not participated in the rally this year. Going down and looking at small mid caps, those are exceptionally attractive. Companies who have debt. So if you think about companies that are growing rapidly, they're consuming capital, and they're highly sensitive to interest rates. And we've talked in the past about innovation. You do have this massive wave of innovation that's come out. Not only AI that's impacted, Microsoft and NVIDIA and some of the larger companies, but the adoption of artificial intelligence with smaller companies could be really meaningful to companies, to smaller companies. The adoption of robotics. There's been a lot of media lately about GLP-1 drugs, which are basically the diabetes drugs that are now being used for weight loss. There's a lot of trends that are happening, secular trends that are really more growth-driven companies, and a lower rate environment certainly could propel those shares to move up significantly higher. So I do think the broader market becomes much more interesting, and we're definitely looking to make some changes in portfolios based on what hopefully will be a declining rate environment.
I agree 100%. And my gosh, if the Fed looks back and says, did they do the right things and are they successful? They must be really patting themselves on the back so far. It's dangerous to say that the Fed has fully stopped hiking. At this point, they are more likely to pause. We'll see how inflation does. We'll see how the data comes. But we've gone through this hiking cycle that they've risen rates by 5+% over a very short period. That almost always precedes a recession. And yet here we are with low unemployment rate, with valuations that aren't unattractive, that aren't uber elevated. And we haven't had a significant market contraction. We've seen volatility, but not a crash, as we would term it. So I'd say so far it's successful. If they're navigating something like a soft landing, then they've done a reasonably good job so far, and that's introduced some opportunities. And to your question around some of those opportunities with the potential of a pause, or if we stopped hiking rates, we saw some of that yesterday, actually, where the 10-year US Treasury yield was down 20 basis points. That's one of the biggest moves of the entire year. That has implications that are not just, okay, well, I'm still earning that good carry for my fixed income. That's actual capital appreciation for holding what's otherwise known as a risk-free bond. So just even in US Treasury bonds, they've seen this extraordinary drawdown from rising rates. We could see US Treasury bonds have a capital return for investors as well, i.e., it might be a good time to add some fixed income exposure for not only reflecting if there's lower growth trend risk, you might see lower rates, which means higher prices on your bonds, but also it's good carry. It's 5% you're locking in. That was another thing that I want to mention, which is if you're sitting in your 1 month or your 3 month CD, you're effectively your cash waiting for something to happen in the markets or saying, gosh, it's really attractive because that's paying me 5%. There was a signal yesterday as well with rates dropping that when you roll that CD, it's going to be lower rates. Your rates aren't going to be as higher. It might be a good time to lock in those higher rates before they drop and gain that before you end up having to roll into a 3% or a 3.5% 1 month CD. You might be able to lock in 4.5%, 5% in longer term interest rates right now.
Thank you. I think I agree with both of you. There are definitely a lot of opportunities in the equity markets when it comes to valuations. And then on the fixed income side, we are encouraging our clients to lock in the higher rate because sooner than later, we'll probably start seeing rate cuts sometime next year. So Adrian, let's shift our focus to US economy, and it's a crystal ball question. But what is your base case for the US economy? Do you think a soft landing scenario or a Goldilocks scenario where inflation truly comes down to Fed's target level of 2% and the US economy does not enter into a recession? Do you think that is your base case, or are you more concerned?
I just took a deep breath because it's always it's a scary thing to comment about. And there's, as an old fixed income guy, there's all kinds of, risk I could point out that could impact the U.S. economy that aren't high probability just yet. And just even on timing, we often talk about the lagged effect of monetary policy, meaning when they rise rates, it's not an automatic negative impact on the economy. It takes about 18 months to work its way through, and here we are, 18 months to coming up on 24 months from when the Fed started hiking its interest rates in March of 2022. So maybe we're, we constantly look for things that may be a manifestation of a downside in the U.S. economy, but it's hard to bet against the U.S. and the U.S. economy. And in the last decade, that would be the wrong thing to do. We've found ways to keep consumption moving, to buffer some of the downside risk. And going forward, that's I see as something the Fed has been able to do, and they've started to mention that they are monitoring for dual-sided risk and can navigate to a soft landing. If we see a large contraction, that probably starts with an unemployment rate that rises dramatically, which we don't see yet. We are starting from a very low base on unemployment rate. If you want a job, you could probably find a job. It may not be the one you want, but we're at a low unemployment rate. That's good for consumer confidence, which is not running high, but it's not in the doldrums. And so we still see some spending. We are watching the earnings cycle to see what corporations are saying about spending and hiring and labor cost. We just went through the third quarter earnings cycle. Positive and negatives. We just came out of a negative year-on-year earnings. So this quarter was positive earnings growth. That's good. Some of the signals we're seeing are a little bit lackluster. Of CFOs and CEOs are telling us that the guidance going for 2024 is less than transparent. We just saw Target report, and they had pretty good metrics. They're up significantly today. And part of that is really that they're giving an inventory guidance that's good, but their guidance for 2024 is wide. They're not sure what's going to happen. And I think that goes for a lot of CFOs and CEOs. We see less transparency and guidance in 2024. That's something that we as fundamental investors will monitor. But we do see, to your question, we see a soft landing right now. We're not looking for a recession in 2024 or 2025.
Thank you. That is very helpful. Now let's shift our focus to something that is very important to our clients and have them concerned, and it's the ever-growing U.S. debt. Earlier this week, Moody revised the outlook for U.S. debt to negative from stable. How concerned are you, and do you think it's going to have any near-term as well as long-term impact on the markets and the U.S. economy?
Really good question. Again, that's another one that makes me take a deep breath because it's not the Moody's signal that even if Moody's downgrades, that's not a surprise, and there's no real impact of that. We are the major debt market of the world. We're the safe haven of the world. When China wants to put its forex reserve somewhere, and then they end up putting it in U.S. debt because it's about the only place they can. Not in Japanese treasuries, not in their own treasuries, and not in Euro treasuries, just not a deep market yet. Now, in an ideal situation, that signal from Moody's, though, is a signal to the populace and a little bit the population that this continued expectation that the economy can be buffered by government spending is something that ends in tears in the long term. It's just a hard dynamic to get out of. Rising rates that we've been talking about don't help that. They certainly decrease our effective interest rate coverage, and the burden of interest rate cost on from our national debt is expected to be one of the largest, if not the largest spending category by, I think it's 2025 or 2026. Those are scary metrics to look at. That said, we're not in isolation. It's not like the Eurozone or Japan has been acting differently. So things in relativity, it's going to be hard for us to lose our global currency reserve status or our safe haven status, which means rates go up and it becomes more costly to borrow and more taxing on the U.S. economy. So that's not a major concern in the near term. In the medium and longer term, we'll need to find either really good growth to grow our way out of our national debt. That's not impossible, but it's not likely, and that's not the story we're looking at currently. Or we're going to need to take some medicine. And medicine comes in the way of obviously lesser spending, but that means higher capital costs. That means higher volatility in the markets as the government stops buffering downturns in the U.S. economy by stimulus driven from Treasury spending in other areas. So looking forward, what high national debt means for us is it does mean longer term elevated volatility, but I don't see yet that prospect of us truly ending up in an Italy type situation where we just have unsustainable debt cost.
Yeah, and even if you look at August, we talked about interest rates moving up again. In August, the U.S. Treasury had a bond issuance that was larger than expected, which caught the market off guard and really drove up interest rates. And this is one of the biggest, I think, risk factors that's out there. But as Adrian mentioned, you've got to look at it within the context. I mean, I always talk about we're the best house on a bad neighborhood, right? It's truly during COVID, most countries just had a ton of fiscal stimulus and just further increased their debt situation. And if you look at China, I mean, if you were talking about debt in particular, China is something that really concerns me. They've incurred 2/3 of the debt that's been generated from a sovereign perspective since the financial crisis. And China's the second largest consumer in the world. So it's situation in the U.S. is concerning longer term, but certainly there are situations to be concerned about from an international perspective and how that impacts us as well.
Thank you. So, to summarize, we have had a couple of difficult years, right? A lot has happened. Last year was terrible for all asset classes except cash. And then this year, while markets have recovered, it's mostly been, your Magnificent Seven stocks. On top of it, we have seen, Middle Eastern crisis, Russia's invasion of Ukraine, China's economy not growing as fast as everybody had expected. So we talked a lot about the negatives and the concerns, but I think it's also important to talk about what green shoots are you seeing. And both of you alluded to some of it earlier, but I think it's important for our listeners that what positives are you looking what opportunities are you seeing in this current environment? Adrian?
Sure. I'll start. Of course, we talked about the divergence in the Magnificent Seven versus those others. It's not just that, it's a divergence in sectors and where sector quality happens. And I'll go back and say, just as you mentioned, the cycle we've seen has been, we've seen a downtrend in fixed income that has been not just multi-decade, but multi-century drawdown in fixed income returns over a period of around 2 years. That's not a full market cycle. That creates opportunity to me. That looks like and smells like potential capital returns for investors over a full market cycle. And this divergence that we've seen in technology versus utilities versus other areas, to me looks like, or the broadening, as Leah alluded to, of the potential in the market looks like opportunity. We as fundamental investors look and go, oh my gosh, like there's 493 stocks on average that aren't up at all this year, yet earnings are up. This potential revenue generation from these thematics that Thea alluded to, that are obesity drugs, that are artificial intelligence, et cetera, are not just captured by 7 stocks. They're captured by other companies that will learn how to use them and certainly deploy them in ways that are revenue generating and good for earnings in terms of generating efficiencies. So I actually think it's a great time for investment. I think it's a great time investment in broadening of the market returns. That's not just in small cap, but that's one area to capture it. And I think it's a good time for investors that want or hold fixed income to capture capital returns, not just interest returns, but good interest returns and good capital returns from a sector that actually you get paid a little bit for holding an insurance policy at this point. If inflation keeps dropping, that's an if, but if inflation keeps dropping, then investors are going to want to hold a reasonably balanced implementation of capturing, for their good reward to risk ratios, good fixed income returns and investing in the equity market.
And I think, Maria, your question is a really good one, because I think right now it's really hard for many investors to get excited. I mean, if you look at the headlines around the world, they're depressing. You see what's happening in the Middle East, what's happening in Israel. It's just really difficult to get excited. But if you really dig down and look at what's happening, Adrian mentioned several things, but like small caps in particular, if you think about during 2020, one of the things that large companies did is they went out and raised capital at next to nothing. They did a bunch of bond issuances. So they increased the cash on their balance sheet by about 30%. And as you've had small caps really underperform, it's cheaper to buy than build. So I think as interest rates come down, you'll have more merger and acquisition activity if you have these inefficiencies with some companies trading at prices below what their private market values could be. So I do think small caps are really are very attractive. The regional banks were up 8 to 10% yesterday. They had very significant moves. So again, as the yield curve changes, and again, we're talking about one data point, but if we continue to see a trend and short-term rates start coming down and the yield curve starts looking more normal again, that's a more beneficial environment for regional banks, a more profitable environment for regional banks. Most regional banks are still down 35% for the year. So I think there's an opportunity there. We did talk about some of those secular themes. We have been in a 2.5, almost 3-year period where companies have not had labor, that we've had a shortage of labor, and we've had supply chain issues, and companies have really had to innovate in order to survive. And that innovation, it's not cyclical. It really is secular themes that should be deflationary and really should have a positive impact on operating margins and operating earnings as we move forward. And again, I don't think that's reflected necessarily in that Magnificent Seven. I think some of those have reflected some of the optimism around some changes, but you can really find some small mid-cap companies that are very attractive, that are embracing and utilizing technology in different ways. So I think it's actually, and we're just talking about the public markets, but I think those are all interesting areas and areas that we're looking to deploy cash and or deploy capital and kind of take advantage of for our clients.
Thank you. Thank you so much, Leah and Adrian, for your insights. I definitely enjoyed it, and I'm sure our clients really loved hearing from you as well. Thank you so much to everyone who joined us on this call. Please feel free to reach out to your advisor if you have any questions. And from all of us at Westwood, we wish you a very happy Thanksgiving. Talk to you all soon. Bye.